Hello, everyone. Welcome to our freight market update for May the 10th, 2022. This is episode 201. I'm Dean Croak, market analyst here at DAT Freight and Analytics. I'm sitting in for Ken Adamo today. He's traveling, but as always, I'm joined by Ned Damon, who's our principal data scientist. And today we have a very special guest from north of the border, Chuck Snow, founder of Traffics in Canada. Good morning, guys.
Morning.
Morning. How are we both?
Excellent. Thank you for having me.
Can't complain.
Great to have you.
Yeah.
So before we get started into the show, diesel up 11.4 cents yesterday, up to 263 a gallon here in the US. That's the national average. Lots of inventory issues here on the East Coast, where, of course, the futures market has settled in New York Harbor. But that's up $2.44 in the last year and up $1.57 since Russia invaded the Ukraine in late Feb. These are staggering numbers, no end in sight. How's it look north of the border, Chuck?
Pretty expensive. I passed a couple of diesel spots this morning on the way down to the office, and 237 Canadian a liter. Okay, and there are 3.8 liters to the US gallon.
Right. Wow.
So do the math. It's pretty costly.
Yeah.
I think it works out to about $7.50 a gallon.
Yeah. Very similar to where I'm from in Australia. They're incredible numbers. All right, well, let's get into the show. Chuck's going to come back and join us a little bit later, but for those new to the program, we're here every Tuesday at 10 a.m. Eastern, 7 a.m. Pacific, talking about the freight market. Most importantly, though, we're here to answer your questions, so they tend to back up towards the end of the show. Get them in early, drop them into the chat section. We've got a team of people working in the background to get them answered for you. So get your questions in early. And with that, we'll dive into some of the freight trends that we're watching in the market. Spot rates are down again last week. It was the largest week-over-week decrease in dry vans so far this year at about 6.2 cents per mile. We were looking for Mother's Day volumes, in particular out of Miami, to halt the reefer spots rate slide. That didn't happen. Even though spot rates went up about 10% week over week in Miami and Lakeland, it wasn't enough to make any or to move the needle on the broader market. Load post volumes for all three equipment types are actually up 13% last week and tracking seasonally with last year. Very interesting data point. Of course, road check week is next week. Normally carriers take time off next week, in particular reefer carriers, more so than dry van and flatbed. The big focus again this year is wheel ends, brakes, slack adjusters, anything to do with wheels. They will be very vigilant on that particular part of the truck next year with a lot of Category 1 inspections. Canadian import volumes, according to Peers, which is an IHS market company, volumes are up about 11% in April, again seasonally on track, albeit slightly down compared to previous years in terms of where we would normally be. The big news, of course, on the West Coast, labour talks started last Friday, involves 29 ports and 22,000 workers. Started on May the 12th, I think it was, and is due to be settled sometime early July. 35 container ships were waiting off Los Angeles last week or early this week. But in contrast, there's 425, yes, I counted them, on marine traffic. There were 425 container vessels waiting off Shanghai and Ningbo. That's significant. They are the number 1 and 3 ports in China. I think it's safe to say that there is a tidal wave of container imports from China coming towards us at some point when that part of the supply chain starts to ease. There's some of the key trends. With that, we'll dive into the market update. We'll start with the load to truck ratio chart for dry van. April was fairly slow, but dry van load post volumes are on the rise, up 5% last week, making it 3 weeks of successive gains. But still down about 35% compared to this time last year. Equipment posts were flat, resulting in the dry van load to truck ratio increasing for the 4th week in a row. Not a significant increase, moved up to 4.01 loads per truck. In the refrigerated sector, load post volumes increased by another 5% last week, of course boosted by Cinco de Mayo last Thursday and Mother's Day celebrations on Sunday. That makes it 5 weeks in a row of successive reefer load post gains, still 51% lower than this time last year, though. Carrier equipment posts were up slightly, and that increased the reefer load to truck ratio to 6.74. In the flatbed sector, load post volumes did surge last week. They were up by 18%. They're about 27% higher than this time in 2018, when the flatbed rate rally was well and truly underway, and were just about 1% higher than this time last year. Volumes are up about 27% in the last month. Equipment posts have been steady. As a result of last week's movement, the load to truck ratio moved up about a couple of points from 70.02 to 72.66 loads per truck. Having a quick whip around our markets, on the market condition index, we had a deep dive into the April import data. As I said at the start of the show, volumes were up 11% month over month. They're actually up about 8% compared to this time last year. And despite the ongoing port delays in China, there are lots of vessels waiting to get loaded and unload. Of course, we're going to see a lot more volatility in port markets once those volumes start to arrive. Vessel bunching and load post volumes will generally follow once that volume starts to hit. Having a look at some of the major ports, the top 4 ports, April volumes in Los Angeles, number 1, and Long Beach, number 3 ports are up 1% and 8% month over month, respectively. On the East Coast, the number 2 port in the country was New York City. Volumes are up 5% last month. And Savannah, one of the bigger ports on the lower East Coast and the Atlantic Coast, it's number 4 port. Volumes are up 32% month over month, respectively, which sort of underlines what we're seeing, this trend of volume shift away from the congested West Coast. April import volumes on the East Coast were up 14% year over year in April, while on the West Coast they were down 1%. The big market, of course, for truckload carriers on the West Coast is Los Angeles to Chicago. A lot of import volume moves on that lane. About 30% of intermodal moves also move on that long-haul lane. Spot rates hit a new 12-month low last week for truckload carriers after being as high as $3.29, that's excluding fuel, last December. Spot rates have dropped by 51% to just $1.62 a mile this week. And are now down 79 cents a mile year over year. That's an incredible drop in capacity on that particular lane. Rates east of Phoenix, it's another busy lane for import volumes into that big warehouse market after being as high as $4.81. Rates are down 64 cents a mile this week. So things are cooling off there, down to $3.27. In fact, overall, Los Angeles market average outbound rates dropped again last week, down 4 cents to $2.22. That's excluding fuel. Having a look at the refrigerated market, we're talking about some USDA data. A couple of interesting data points this week. Most markets were in adequate supply of trucks in all but 2 regions, eastern North Carolina, where we grow a lot of sweet potatoes, and central and southern Florida, where we grow a lot of vegetables. Trucks were in short supply in those 2 markets. Slight shortage in San Luis Valley and Colorado for potatoes. That's always the case in that particular market. Michigan apples, short supply. But for the first time this year, there was a slight surplus of trucks reported on the southern border in Texas. Import volumes from Mexico were down 2% last week, creating the imbalance. Having a look at some of the lanes out of the McAllen market, far Texas, that is, to Chicago, dropped to a new 12-month low of $2.21, excluding fuel. That's 24 cents a mile lower than the previous year. And of course, this is when we normally see volumes from Mexico start to peak, especially in May. It's generally the peak season. Far Texas in the McAllen market to New York City, similar trend, dropped 30 cents a mile to the in April, below the April average, to $2.53. That's also around 30 cents a mile lower than the same week last year. In Lakeland, where, of course, we have a lot of produce, even Miami, when I put those 2 markets together, rates jumped 26 cents a mile to $2.16, of course, driven by Mother's Day, fresh cut flour volumes that land in Miami. In the Southeast region in general, where produce season is starting, when I take into account southern Georgia and Florida, spot rates increased 10% last week, or about 27 cents a mile, to a regional average of $2.24. That's excluding fuel. So even though produce volumes are starting to move out of some of those key markets in the Southeast, they are insufficient to move the needle in terms of rate direction thus far. In the flatbed market in Gary, Indiana, we generally cover this one. It's a large steel producing market. Capacity eased considerably last week. Rates dropped to $3.28. That's 82 cents a mile lower than last month, and about 69 cents a mile lower than the previous year. One of our big markets we cover every week is Houston. It's our largest flatbed market. Capacity eased on the number 1 lane between Houston and Fort Worth. spot rates dropped about 50 cents a mile. That's significant. That's 50 cents a mile lower than the April average to 337 excluding fuel. Loads west to the Permian Basin, capacity also eased out of Houston. Spot rates were down 40 cents a mile below the April average to an average of 328. It's still 67 cents a mile higher than this time last year at 328. In Los Angeles, capacity tightened last week. Spot rates are up 28 cents a mile to 295. And just south in San Diego, where a lot of steel imports come in on the break bulk vessels, spot rates are up 24 cents a mile to an average of 279. So that's our market condition index wrap up for the week. Now we'll have a quick look at the year-over-year spot rate charts. And in dry van, spot rates recorded their largest week-over-week decrease, down 6 cents to an average of just 205. These are extraordinary numbers, especially when you think about how much diesel has gone up. Compared to the same week last year, dry van rates are now 30 cents a mile lower and have dropped 73 cents a mile since the start of this year. And for broader context, last week's national average is still 47 cents a mile higher than the average of pre-pandemic years going back to 2016. Similar story in the refrigerated market. As we covered, we didn't see a bit of a bump from Mother's Day volumes. Rates plunged even further down, another 5 cents per mile to a national average of 234, excluding fuel. They've dropped 22 cents a mile in the last month, and about 26% or 82 cents a mile since the start of this year. Last week's national average is still 42 cents a mile higher than the previous non-pandemic years. And wrapping up with our year-over-year view of spot rates, after being relatively flat for the first 4 months of this year, flatbed spot rates dropped for the third week in succession, following last week's 3 cents per mile decrease. Rates ended the week at 264, excluding fuel. That's about the same as this time last year, but 28 cents a mile higher than the same week during the 2018 flatbed rate rally. So that's it for this week's market update. And if you'd like to find out more about what's happening in freight, go to dat.com/market update and download our long form weekly report. And with that, it's over to Ned for the short-term forecast.
All right, we are going to be starting off with our dry van forecast. In the dry van forecast, you can see in blue the market rate observed by DAT, and then off to the right, you can see our forecast models. In red, you can see the short-term forecast, which is expecting the current slide to continue down into the right, ending at about $1.75 as we move into the early part of June. Next in green, you can see the Ratecast model. Ratecast is expecting, any day now things to turn themselves around. Ratecast performance recently has not been as good, and that's likely due to the ongoing slide, which is something that in the entire history of Ratecast has not been observed, a drop of this magnitude and duration. In the middle, we have our blended forecasts in gold and silver. Gold and silver being mixtures of those two forecasts in different amounts and in different ways. You can see that they're kind of straddling that middle distance with a flattening out as we head into May, the later part of May, rates stabilizing at about $1.85 per mile. Moving on next to reefer. Once more in blue, you can see the market rate observed by DAT. And then off to the right, you can see our forecast models. In green, the Ratecast model is expecting normal seasonality to assert itself, but that seems not to have been the case continuing forward, as Dean was talking about. While our short-term model is expecting the slide to continue basically unabated through into June, with rates falling to about $2 a mile as we head into the early part of June. In gold and silver are our blended forecasts, which are mixtures of the two forecasts in different amounts and in different ways. And once again, they're expecting a downward slide, although less aggressive than the short-term model, with rates falling to about $2.15 a mile as we head into the middle part, the early part of June. Finally, in flatbed, once more in blue, you can see the market rates observed by DAT. And then off to the right, you can see our forecast models. In green, the Ratecast model is expecting that the current slide will correct itself and normal summer seasonal patterns will assert themselves, with rates rising to around $2.70 a mile. And you're going to keep hearing this exact same story. In red, the short-term model is expecting that the current slide is going to continue and may even slightly worsen in terms of the slope of the drop, with rates falling to about $2.50 as we head into, sorry, 255, I misread, as we head into the early part of June. There we go. Finally, the blended forecasts in gold and silver, which are mixtures of the two forecasts in different amounts and in different ways, are expecting that rates are going to fall by about 5 cents and then stabilize, landing themselves at about 260 a mile as we head into that early part of June. And with those forecasts out of the way, it's time for our IQ question of the week, which is IQ question of the week. What has changed in Canada since the last time we chatted?
Great question.
Broad question. Yeah.
So, as predicted, the domestic Canadian freight, and the last time I was on this show, freight rates domestically were going sky high. Rates I had never seen in or even dreamt about in my 48 years in this business. Just total insanity. And the reason for that was because there was a shift really in markets, and as predicted, and I'm not always right. I happen to be right on this one. A lot of unvaccinated drivers who just chose not to go into the U.S. anymore filled that void, and the demand certainly was exceeded by the supply of available drivers. So the domestic freight rates have come way down. I don't want to say they've plummeted, but they've certainly they've gone way down from where they were a month or two ago.
Right.
They've gone towards a new normal, and heading towards the old normal.
That's interesting, Chuck. I remember the show. It was, I think, you were on the show about the time or just after the blockades had started, right. And the two things you predicted were that spot rates would certainly decrease north of the border because of the increase in capacity, but the reverse would happen south of the border, and we've seen that happen. It's interesting. LoadLink's March report came out yesterday, Chuck. I don't know if you've seen it, but they mentioned that volumes are still up. So their spot market volumes in March are up about 125% year over year. That even surpassed February's all-time record. The March load to truck ratio for dry van in Canada is about half what we'd normally expect March to be. But they did say that this is the first time they've seen capacity grow, albeit slowly, in the cross-border market. So there are some signs that possibly capacity is coming back to the market. And I'll give you some numbers here. One of the things we talked about, even on your show recently, was some of the lanes that run into Toronto, right? So Huntington, West Virginia to Toronto.
Right.
That's a busy lane. A lot of exports go out of Huntington to Toronto. Average is $2.40 a mile. In February, when the blockades happened, it jumped. Spot rates on that lane jumped 42% to $3.70. February to March. By the end of April, they'd risen another 21% to $4.50. This week, they've dropped, but only by 5%. So they're back to $4.27. There's a similar trend on three other key lanes. The one we've covered a lot, Chuck, is Laredo to Toronto, also known as Auto Alley. Average is about $1.50 all year, typically. February, when the blockades happened due to the mask mandates, rates spiked 41% to $2.37. By the end of April, they'd risen another 28% to $3.04. This week, down 4% to $2.92. Same story, Detroit to Toronto, busy auto parts lane, normally about $6.40 a load. February, it jumped to $1,060 a load. It peaked in the end of April at about $1,250 a load. This week, it's down 20% to $1,000 per load. So the LoadLink folks in north of the border said that there's some capacity coming back to the market. Are you seeing a similar thing? Because it would suggest that we've certainly got a little bit more capacity south of the border.
You know what? I don't think so. I think those are two lanes that are heavily focused on auto parts.
Right.
And when we're ripping the covers off of the auto part sector and the automotive sector, there's so many other things that we have to look at. Are some of these plants not buying as much product from their contracted suppliers in the U.S. and perhaps even in Mexico, because they're missing components to complete builds. So they're not bringing in that third shift. So I'm going to guess from what we're seeing on regular freight lanes, we're not seeing that the rates going down other than with automotive, which I have heard from other people. We're not heavily connected with automotive. We do a little bit, not like, and a lot of times you have companies that are just focused on automotive, and our people have had several calls from automotive haulers, drivers and owner operators looking for work because it hasn't been as busy the last couple of weeks.
So it's limited to specific lanes. Got it. What else are you seeing in your market? One of the things you mentioned on the last show was there was a lot of drivers that just refused to go south of the border.
Is
that likely to change?
No. You know what? I honestly, the odd one is relenting because they're seeing the financial results of their decisions, and especially owner operators, and they're going, you know what, I can make a lot more money crossing the border. Maybe I better get that needle. But there's a time period they've got to have 3 shots altogether, I believe, to cross the border. So I don't think, it's not a quick fix. The other thing that is happening, I think, is you do have, you still have an awful lot more new entrants, even in this market, that are willing to plunk down $30,000 or $35,000 for insurance in order to become a new carrier. And these are people that were either leased on to a carrier, or even drivers that are willing to go out and spend a lot of money and buy a tractor. And miraculously, some of them are getting trailers. I don't know where the heck they're getting them from, because there's not a whole lot available. And then some of them, of course, are hooking up with some of the large carriers that do power only. Yeah, but they're working independently.
Yeah, that was something that we saw a lot south of the border. Back when there was really big carrier growth last year, is there were not as many brand new market entrants, but you saw a lot of people moving from leased on to, or driving to hanging out their own shingle.
Right. We are seeing a fair bit of that right now. And there are some companies, it takes, we want them to have some experience before we want to load them. And most brokerage houses are like that, but you know what? There are small 3PLs, and there are carriers out there that are so desperate for capacity. My God, they'll give loads to anybody.
Chuck, when you talk about new entrants to the industry, you're talking about new entrants in the Canadian market that work intra-Canada?
No, nobody I know of is because the rates have plummeted on that inter-Canada.
Right. Okay.
It still appears to be sexy to cross the border.
Yeah.
So you have owner operators or leased operators or even company drivers that, today freight rates are all over, they're all over the media. You can listen to so many shows and get an idea of what freight pays. And they want to throw their hat in the ring on that. They think that they hear these rates of $4 a mile, not realizing that when you're paying $30,000 or $35,000 for insurance, all of a sudden you're paying 3 times as much insurance as an experienced carrier pays.
Yeah.
The LoadLink's data for March was very interesting. I think it supports a lot of the new entrants coming into the industry, but also this shift from contract to spot because of the capacity tightening. Their March load board volumes are up 237% year over year in March. They're extraordinary numbers. So I think that underlies this significant shift from contract freight moving cross-border to the spot market. Would that be consistent with how you've seen things?
Yes, and you also have to remember what happened here was Schneider pulled out of Canada.
Right.
And they had a terminal up the road, probably about 15 miles away, in Aberfoyle, Ontario, and I believe they had around 1,000 trucks domiciled out of there.
Wow.
And they left town in March. And they just decided that it wasn't worth having a facility up in Canada. So that left a lot of, now they still run cross border, but things changed because now all of a sudden you've got to give, have to have American drivers that are willing to cross the border into Canada. A lot of them just would rather not, because it's just, it's another traffic jam that they have to deal with.
Right.
And they'd prefer not to. So that certainly took away from capacity.
Right. Yeah, that was something I haven't thought about. That's a lot of contract loads they would have been moving for some of those. What if it's tied to auto parts? I mean, that has to be tied to some of the auto parts downturn.
Everything. You know what? A great company, multifaceted, huge in contract auto parts. They got their, Schneider cut their teeth in the paper industry, servicing that. They were still very big in paper when they left. And then a whole bunch of other industries.
Yeah, wonderful company. Pride has a color, as they say. That famous orange color is you see it everywhere on the trailers, the used trailers and trucks all over the country. Any other news from further out west? And when you say out west, Western Ontario, but I'm talking about west as in way out west, British Columbia area.
Well, yeah, British Columbia, things seem to be stronger than I have ever seen. Because normally when trucks got out to BC, we used to call them triangles, and you would run from Toronto to Vancouver, and then maybe if you could beg or borrow a cheap load from Vancouver to California. Sometimes you just went empty, depending on the time of year and the rates. And now the ports in British Columbia are fairly busy, Port of Vancouver. Exactly. And it's very, I don't want to go out and say it's very well run, but it's much better run than it used to be. They're able to unload ships fairly quickly. There's a lot of freight leaving Vancouver now that I don't think was ever available before. So there's a real strong, market there. And rates,
volumes are up in, I can't remember the exact number, but volumes are up, as they are up in most ports that aren't Los Angeles or Long Beach. There's definitely been a shift away from those ports.
They've certainly picked up some of that freight.
Yeah.
And it's funny because I remember getting a call from a potential customer about 10 years ago, and the guy was just about in tears. He had samples coming in that he needed for one of the big box stores, that was Walmart or Home Depot, on a vessel that was it had already landed in Vancouver, but it was going to be weeks until they could get it offloaded. And he was looking at alternatives, and he said, I'll bring the darn stuff to Baltimore next time and get you to truck it in out of frustration. But they've really, really done a good job. So my understanding in pulling up their socks.
Yeah, we've seen a shift in volume away from the West Coast to the East Coast, as we covered earlier, but in particular to ports like Houston, right, where they're coming into Houston on those Neo-Panamax vessels through the Panama Canal and then trucking it back west, which is kind of bizarre when you think about it. Chuck, just one more question on the driver supply side. You have an asset-based side of traffics. How hard are drivers coming back to the market in Canada?
No. Number one, they're not coming back to the market at all. You would think that with pay increases in the industry, there would be more drivers. Now you're always getting newbies, but most companies can't hire them. Now some of the big ones are able to, because they have the internal ability to take those new drivers and mentor them and teach them how to get to the next step after they've attained their, what we call an AZ in Ontario, but their CDL. one of the big issues that, and it keeps going on. It's almost embarrassing of our government. We have this thing going on called Driver Inc., and
Yes.
where companies are paying truck drivers to work for them as corporations, and the federal government is refusing to do anything about it, much to the chagrin of carriers that won't pay their drivers, and we're one of them, as corporations, because number one, it's not legal, and it could get very ugly, especially if somebody gets hurt, or somebody loses their life. It could take a company down. But there seems to be no desire from the federal government to change anything, which is very surprising. And the only thing personally that I can think of is they're almost afraid.
Yeah.
Is this the dump truck crowd around Ontario?
No, this isn't the dump truck crowd. I don't know much about the dump truck people. This is the long distance highway drivers that are that insist on being paid as corporations rather than being paid on payroll. And they will work for a lot less to be paid as a corporation. I guess they feel they get write-offs, which they really don't, because Revenue Canada won't allow them the write-off. And we did a show one day on our podcast, Rates and Lanes, an hour-and-a-half show, and we had some experts on, and we really couldn't understand why there was no desire by the government to change this.
All right. Well, Chuck, we've loved having you on the show today.
Yes.
It's gone quickly. We're a little bit over time. So with that, I think we might wrap things up. As you can see in the chat section, folks, there's a question link. You can send your questions into
Please do. Yeah.
askiq@dat.com. In terms of shout outs this week, we've got a busy week this week. I'll be on the Sales Chatter show that Chuck talked about a little earlier with Dan Deegan and DJ Flores at 9 a.m. Eastern. It's Data Wednesday. You can connect with them on LinkedIn and get the show link for tomorrow morning. Then I'll be speaking at the International Conference of Furniture and Transportation Logistics Managers tomorrow afternoon in Fort Lauderdale. Then Stephen Pettit's going to be on Landline Now at 7 p.m. Eastern tomorrow night on Road Dog Radio, Sirius XM Channel 146. I'll also be on Road Dog 146, 8 a.m. this Thursday on Radio Nemo, talking about the freight market with the wonderful Jimmy Mack. And of course, don't miss this week's latest edition of Freight Vine with Professor Chris Kaplas and Brett Bebout, president of Quiet Platform. They're a firm that's specializing in scalable e-commerce back-end solution. And with that, we'll call the end of the show. Thanks for watching, everybody. Have a great rest of your week.
Thanks for having me. Have a great week.